the most controversial Fed decisions of the past 112 years. For over 100 years, the Federal Reserve, America's central bank, has shaped the nation's economy. But not every decision has been popular or easy. Get ready to explore the most controversial decisions in Fed history. Before we dive in, very quickly, some disclaimers. I am not politically left or right-leaning. I consider myself compassionate but without compromise. I may agree with or concede some objections and points made in the comments. My objective is to initiate civil dialogue on controversial subjects. It's good to have a healthy debate to create awareness and perspective. For example, most people think the Fed is the federal government. It's not. Please have friendly discussions. It's okay if people agree to disagree. To make these videos, I have to work within the venue's policies and biases. I can't use some title suggestions because they could get these videos banned. All information is provided for general information use only. Nothing in these videos is rendering any professional advice. Please don't blame me for various institutions or policies set up 60+ years ago, and then rate me harshly for events that happened before we were born. Let's treat each other in a respectful, friendly, and professional manner. Okay, now let's get started. Please hit the like button, the subscribe button, and the bell notification. The Great Depression in early years. For much of its early history, the Federal Reserve struggled to respond to a crisis, and nowhere was this more controversial than during the Great Depression. In the late 1920s and early 1930s, as America's economy collapsed, the Fed failed to prevent the wave of bank failures and allowed money to become painfully scarce. Many historians argue that the Federal Reserve's inaction and tight monetary policies made the Depression far worse, causing lasting damage to families, businesses, and public trust. In 1931, with the economy already deeply troubled, the Fed actually raised interest rates to protect the gold standard. This move backfired, intensifying the downturn and worsening unemployment. Or did it fail? Perhaps it was done to protect the wealthy elites. A turning point came when the country abandoned the gold standard in 1933. President Franklin Roosevelt, working with the Fed, made the controversial decision to suspend the dollar's link to gold, giving the government and the central bank more room to fight the crisis, but also fueling debate about monetary stability for years to come. Even after World War II, the Fed faced new controversies, like capping interest rates to finance the war effort, which some feared would let inflation spiral out of control. The lessons and deep scars from the Fed's early years shaped every decision that would follow. The controversies born in this era still echo in debates about central banking, independence, and crisis management today. The inflation era, 1950s to 1980s. After World War II, the Federal Reserve faced a new challenge: how to balance growth with the threat of inflation. In the 1950s and 60s, the Fed often shifted between tightening and loosening money, confusing markets and sometimes making booms and busts even worse. During the Vietnam War, government spending soared. Instead of raising rates to keep inflation in check, the Fed kept money easy, leading to rising prices throughout the late 1960s. But the real crisis struck in the 1970s. The economy faced something new: stagflation, where prices shot up even as unemployment stayed high. The Fed's attempts to fight one problem often made the other worse, shaking public faith in central banking. Everything changed in 1979 when Paul Volcker became Fed chair. Determined to crush runaway inflation, he raised interest rates to almost 20%. The plan worked, but at a major cost. The country was pushed into deep recession, unemployment spiked, and Volcker's policies became some of the most controversial in Fed history. Despite the pain, this era proved one thing: failing to control inflation can have lasting and sometimes disastrous effects on the economy, and that the Fed's toughest choices are often its most debated. Asset bubbles, bailouts, and deregulation, 1990 to 2010. The 1990s and 2000s brought new controversies as the Federal Reserve faced rapidly changing financial markets and crises fueled by risky bets and deregulation. As the economy boomed in the late 1990s, Critics argued the Fed's easy money policies helped inflate the dot-com stock bubble, and when the bubble burst, the Fed quickly slashed interest rates to cushion the blow. But keeping rates low set the stage for the next problem, an explosive housing bubble. Throughout the early 2000s, the Fed maintained ultra-low interest rates and offered little pushback against looser lending rules. As housing prices soared, risky mortgages spread through the financial system. When the bubble finally burst, the result was a global financial crisis, unlike anything since the Great Depression. The Fed's responses, from bailing out Bear Stearns and AIG to letting Lehman Brothers fail, sparked fierce debate. Some accused the Fed of saving Wall Street at the expense of Main Street, while others argued these moves kept the entire financial system from collapse. Through this era, the Fed's willingness to backstop markets, rescue institutions, and use new tools like quantitative easing changed the role of central banking forever, and left Americans divided over whether it was a savior, an enabler, or both. Unprecedented monetary expansion in the modern era, 2010 to today. In the wake of the Great Recession, the Federal Reserve entered uncharted territory. It launched waves of quantitative easing, buying trillions in government and mortgage bonds to support the economy and keep interest rates near zero for years. These moves were praised as life-saving by some and criticized by others as reckless money creation that could spark new bubbles or inequality. Market turbulence didn't stop. When the Fed hinted it might slow bond buying in 2013, the so-called taper tantrum, markets swung wildly, reminding everyone how sensitive the global economy had become to Fed policy. More recently, emergency interventions hit new milestones. In 2019, the Fed pumped billions into short-term lending markets to prevent instability. Then, when the COVID-19 pandemic struck, it unleashed unprecedented measures, slashing rates, launching emergency lending programs, and even buying corporate bonds and ETFs. While these actions helped stabilize the economy, critics warned they could deepen wealth gaps, encourage risky speculation, or make it harder to control inflation in the future. Meanwhile, the Fed came under fire in 2021-2022 for failing to act quickly as inflation soared, then shocked markets again with its fastest pace of rate hikes in decades. Today, the Federal Reserve's powers are greater and sometimes more controversial than ever. Its every move is watched worldwide as Americans debate the risks and rewards of unconventional monetary policy in a fast-changing, unpredictable world. Controversies over Fed power, politics, and transparency. Beyond interest rates and economic crises, some of the most persistent controversies surrounding the Federal Reserve involve its power, its relationship with politics, and how open it is with the public. The Fed was designed to be independent, to shield monetary policy from short-term political pressures, but over the decades, it has faced repeated accusations of bowing to presidents, Congress, or Wall Street interests, especially during times of economic stress or election years. Transparency is another ongoing debate. For much of its history, the Fed operated behind closed doors, keeping its deliberations secret and its decisions opaque. Though it now regularly holds press conferences and releases meeting minutes, critics still worry there's too little public oversight for such an influential institution. The Fed's dual mandate, balancing inflation and employment, also draws controversy. Some argue the bank puts too much emphasis on fighting inflation or helping financial markets, while others claim it should focus more on supporting jobs or reducing inequality. Finally, the sheer scale of the Fed's actions, bailing out banks, buying trillions in bonds, and backstopping entire markets, raises questions about whether one institution should hold so much economic power and whether the system is truly fair for ordinary Americans. Today, these debates over accountability, independence, and transparency aren't just history. They shape every major decision the Federal Reserve makes and affect the financial future for us all. Please hit the like button, the subscribe button, and the bell notification. Please let me know in the comments what other Fed topics you want me to decode.